Hey, what's up you guys? Welcome back to the channel. Today I'm going to show you guys how you can start investing with Fidelity. If you're new to my channel, my name is Min. I like to save money and build wealth. Let's get into the video. Now, if you're watching this video, you probably have no idea where to even begin when it comes to investing. But stick around, I'm going to show you guys how you can open your own Fidelity account so you can start investing today. Now, normally I would do my investing in Charles Schwab. That's where most of my accounts are. But for this video, since we're going to be doing a different technique called dollar cost averaging, where we invest consistently every month the same amount, we need something called fractional shares to do that. And Fidelity offers this feature through their app. Now, you don't have to use Fidelity. You actually can use Robinhood as well. The same technique will work on Robinhood. If you guys don't have an account for Robinhood, you can check my link down below and sign up for an account just as easily. So let's go ahead and head to fidelity.com and create our account. Okay, we are now on www.fidelity.com. It's that simple. Just go here and you're going to want to click this big orange button and open yourself an account. And you're going to select brokerage account. Don't worry about the other ones for now. Once you click that button, you'll be presented with this screen. This is where you'll enter all of your information in, like your social security and whatever they require for you to open your account. Once you do that, go ahead and log in and you'll be presented with this screen. So once you get here, you'll want to go to account balances and you're going to want to fund your account. And as you can see here, I already have my $1,000 in here. And what you're going to want to do is actually link your bank account to this account. That way you can transfer money in and out to this brokerage account. Now, if you don't have $1,000 to invest, you don't have to pick $1,000 every month. That's just the number that I'm picking, so that way I can reach my goals. You can start out with $100, you can start out with $200, or whatever you're comfortable with, or whatever you can afford. It doesn't really matter as long as you're investing something and you're doing it consistently, so that way it's part of your budget. It's pretty much like setting aside money and paying yourself first and investing it for your future. Now, the reason why we need fractional shares is so that we can dollar cost average. And all that means is you're gonna be buying periodically so that way you can avoid all of the highs and the lows of the stock market. Now, obviously you wanna buy at the low and never at the high, but in order to do that, you would have to be some kind of magician and you would have to know exactly when to buy. And trust me, nobody knows when to buy. So it's better to just put money in every month or every week or every quarter. Now for me, I'm gonna be putting in money every month on the first and making my purchase on the second. And that's just what I'm gonna be doing. You guys can do the exact same thing if you like, but that's how I'm gonna be investing. And one thing that's very important here is that time in the market is more important than trying to time the market. So by dollar cost averaging, you're consistently in the market throughout that entire time. Versus if you were trying to find like the lows and the highs, you would keep your money on the sidelines for 3 months and try to put it in, and you'd be in and out all the time. And if you don't guess right 100% of the time, you're losing out on potential gains in between. So now that we got that out of the way, we are pretty much ready to start buying, but we're not going to be buying on the desktop app. Unfortunately, Fidelity only supports fractional shares on their mobile app. But before we even go to the app, you're probably wondering, well, what the heck do I buy? What stocks do I buy? Is there a specific one I should be buying? And if you're new to investing, then my suggestion to you is to not buy stocks at all. Buying a stock for one company is pretty risky in the event that that company goes out of business. Imagine if you bought a stock like General Motors. If they went out of business tomorrow, you would lose all of your investments. But imagine if you bought maybe 5 car manufacturers, right? 5 of them going out of business is probably not gonna happen. So if that sounds better to you, I suggest you stick to ETFs or exchange traded funds. These are a collection of companies all rolled up into one fund. And there are so many ETFs out there that represent different things. But the nice thing about ETFs is that normally there's like 50 or 100 or 200 companies in one. Now, ETFs do have a caveat in that they do charge a fee for buying such a fund. And this is called the expense ratio fee. Now, the expense ratio is relatively small, and the only reason they charge this is because they have to manage all of those shares in there and bundle it all together and do all the taxes and whatnot. So that way, when you buy it, you don't have to worry about anything. Now, these expense ratios vary from fund to fund, but typically they're about 0.4% or 0.01%. It pretty much varies. And what that means is for every $1,000 you invest, that's the fee that they're gonna charge you. So for a 0.44% expense ratio, you'd be charged $4.40 for every $1,000 you're investing per year, which is not too bad at all. So for me, the ETFs that I'm going to be buying for this portfolio are going to be heavily weighted for growth and technology. Now, this is somewhat highly unsafe because this is all part of maybe 1 or 2 sectors only. And so you may want to diversify a little bit and find other ETFs if that's something that you want to do. But for me, since I'm still in my 30s and I have about 20 or 30 years left before retirement, I know that technology and some of the companies in these ETFs are going to make it big down the road. At least that's the bet. Now, I'm not your financial advisor. I'm just merely showing you guys how you can start investing and some of the things that you can think about when you buy your first ETF. So we're gonna go ahead and head over to my screen, and I'm gonna show you guys the 4 ETFs that I'm gonna be buying for this growth portfolio. And I'm gonna be investing $250 a month for each of them every month until I retire, at least hopefully. So let's go ahead and head over to the screen so I can show you guys what those 4 ETFs look like. So this is the first ETF that I'm going to be buying. If you want to see a page like this, you just need to search for the stock ticker symbol here and just find it on Fidelity, and it'll give you a nice summary of that ETF. And the first thing I want to mention is the expense ratio, and you can see here it is a 0.0945% expense ratio. And all this expense ratio means is you're going to be charged 94.5 cents for every $1,000 you invest into this ETF. And so you can see here the ETF costs $357.70 as of today. And you can see right off the bat, I cannot afford one full share of this because I'm only investing $250 in here. And so that's why fractional shares is going to be important. We're only going to be able to afford maybe 2/3 of a share with $250. But one thing I wanted to show you is on every ETF, you're going to be able to look at all of the holdings and also the performance of this ETF. And so here you can see the top 3 holdings are Apple, Microsoft, and Amazon in this fund. Most of the companies in this fund are from the United States, which makes sense because this is the S&P 500. And all this means is just the top 500 companies in the US are part of this fund. And then you can look at things like performance and see how it's been performing. And so you can see SPY is very close to the S&P 500. This is just their version of the S&P 500. And you can see the performance is almost identical. And so by buying this ETF, it's like you're buying the S&P 500 index, which is a very popular index to buy. Now, if you scroll down a little bit farther and you're curious what is actually in this fund, well, you can see here top 3 holdings are Apple, Microsoft, and Amazon. But if you were even more curious, you can scroll down and look at top holdings and look at the 506 holdings in here and the percent allocation for each one. And so you can see here companies like Google are in here, Facebook, Berkshire Hathaway, Visa, Procter & Gamble, Nvidia. These are all really big names, and they're big companies in the US, so it makes sense for them to be in here. But you can see Walmart's in here, and you can rest assured that all these companies are not going to go bankrupt, and a lot of them are probably going to grow in the US. And so this is a safe stock to invest in. The next ETF that I'm going to be investing in is called QQQ, and this is a highly concentrated tech ETF, and it has a lot of tech companies in it. I know earlier in SPY, you saw a lot of tech companies in there because tech companies happen to be the top 500 companies in the US. And so you'll see a little bit of overlap. But one thing you'll notice is not a lot of companies are actually in the S&P 500 yet. There are some criteria you have to meet to actually be part of that list. But I'm buying QQQ because it has a small percentage of Tesla in here. And I want to own some Tesla stock long term without having to buy Tesla directly. And so if I go down to holdings, you'll see even in the top 10, Tesla is right here at 3.53% of this fund. But you can see other top companies are in here as well, like Adobe, PayPal. I mean, we can look at this list. There's only 100 companies in this ETF itself, but you can see things like Costco are in here, T-Mobile, Broadcom, a lot of big name tech companies, which is what I want to invest in for this portfolio. And you can see here the expense ratio is relatively inexpensive for this fund. So for every $1,000 you invest, you would be charged $2 per year. The next ETF that I'm going to be investing in is a cloud computing fund from Wisdom Tree. And so you can see here their expense ratio is a little bit higher at 0.45%, but this fund is actually worth it to me because they've been growing significantly. You can even see down here, it's been growing 84% this year alone because a lot of tech companies have just blew away the pandemic. It hasn't affected them one bit. And one thing I like about this company is if you look at the holdings, you'll see that, Zoom is in there and a lot of new tech companies, and some of these you may never have heard of if you're not in the tech field, but a lot of these companies are actually used quite a bit. And so you can see like Atlassian, this is used for project management and product development. Zendesk is used for bug tracking. DocuSign is used for doing e-signing for like contracts. Salesforce is a CRM to manage customers. And so you can see a lot of these companies are smaller name tech companies that may not be known to the wider audience. But for someone like me who works in the tech field, I know a lot of these names. And so I know that these companies are really valuable and really important. They may not just be known yet, but down the road they will be, right? Just like Apple and Tesla. Those guys took a while to be known. And so I've invested in this fund because it has a lot of the names that I really like and want to invest in. And I don't want to buy individual stocks. And so by buying this ETF, I get a little piece of all of these companies. Companies like Shopify, which is really interesting to me. Companies like Okta, which do authentication. Companies like HubSpot, which do marketing automation. Companies like Dropbox, they do online storage. Companies like Datadog, they do server monitoring. Companies like Twilio, who do SMS and emails. And so a lot of these companies have a lot of upside to them long term. The next ETF that I'm going to be buying is related to financial technology. And so earlier I mentioned a lot of cloud computing, I mentioned a lot of tech companies. This specific ETF is related to more financial tech. And the reason why I like this fund a lot is because I think it's going to disrupt the banking industry and move people more towards these new technologies. And so this fund has a really high expense ratio. If you don't know who ARK is, this company is a really well-known company for investing in Tesla early on. They have another fund called ARKK, which invests in technology innovations, and Tesla is part of that. I think it's 10% of that fund. And so you can imagine now that Tesla has kind of gone crazy, this company is very well known. And ARK has several funds that represent different sectors. And so if you want to invest in just ARK by itself, just know that it has a high expense ratio, but they have really top companies in those funds. So let me show you down here. So down here you can see they have 46 holdings in this fund, and the top one is Square. And Square, if you don't know what Square is, whenever you go to a small mom and pop shop and they have those little machines where you can pay with your credit card, those little machines are made by Square. All those ugly old IBM, keypad things that people use, they're all being changed over to either Square, or there's a competitor I believe called Clover. So you'll see a lot of new small businesses using these machines to handle all of their transactions and credit card payments and inventory and things like that. So it's all built into this little machine, and it's super cheap for them to buy and easy to maintain. But I also like a lot of the other companies that are in this ARK fund. You can see companies like Zillow, Pinterest, and you can see Apple's in here again because they have Apple Pay. But PayPal is in here. I mean, PayPal is kind of an old timer, but they're kind of the start of all of this, right? We have companies like Facebook that's in here, which they have, a marketplace now. And then you have companies like LendingTree, which is an online peer-to-peer lending. Rather than going to the traditional bank to borrow money, you can borrow directly from someone and just pay a small fee. Companies like Intuit are in here, the owners of Mint.com, which I use personally to track my expenses and my net worth. And so you can see here, there's a lot of different companies in here, and you'll notice there's not a lot of traditional banks in this list. That's because I think a lot of that is going to go away as we kind of move forward into the future. A lot of people are now using Venmo and PayPal to pay each other. I know Venmo's not on the list, but you kind of get the point with what I'm going with. And so that's why I like this fund. And you'll even notice if you look at Square individually, you'll see that their stock has shot up dramatically since the beginning of this year, even in the last 3 years. So now that we've looked at all these ETFs and understand the expense ratio and some of the holdings involved in the fund, let's go ahead and go over to the Fidelity app and buy these funds now.
So all you're going to do is just log into your Fidelity account, and you can see here I've already got that $1,000 in here like I showed you guys earlier. As you guys can see here, I have one portfolio in here. It is the growth ETF portfolio. Obviously I don't have any positions right now, but we're going to go ahead and add some. And it's really easy with the app. All you need to do is go to transact, trade. Now the reason why I'm using Fidelity is the fact that you can buy fractional shares for any ETF or stock. So like I mentioned earlier, we're going to buy 4 ETFs, $250 a piece, and we're not going to really care about what they're trading for at the moment because we're doing dollar cost averaging, and we're buying the same amount of money every month until the end of time. So let's go ahead and buy QQQ. And here you just change it to dollars and just do $250. And so you can see here, because of fractional shares, we actually can't afford one full share. One full share is about $302 right now. And so we're gonna have about a 0.825 shares when we execute this order. So let's go ahead and hit preview, and let's go ahead and just review things really quick, and it looks fine. There's no commissions, which is great. And let's just place our order. So there you go. And it's as simple as that. That is our first order, and you can see if it's been executed, and you can see it says status filled, which is great. That means that you actually own this QQQ ETF now. And you can see here I own 0.825 shares, and these numbers will update as time goes on. So let's go ahead and buy the other shares now really quickly. So we're going to be buying WCLD, which is the cloud computing ETF, $250 again. And we're going to do a market buy and just hit preview, and let's go ahead and just place the order. So let's move on to the next one, which is SPY, which is the S&P 500 index. and we're gonna do the same thing. So SPY's at 357 right now. We're gonna buy $250, which is not quite 1 share. It's about 0.7 shares, and place it. And then the next one we're gonna buy is ARC-F, and here we're gonna do dollar again, and we're gonna do $250. And in this case, we actually can't afford 6 shares, but we're gonna do $250 just to be consistent, and then go ahead and place that order. So that's pretty much it, guys. At this point, you own $1,000 worth of positions, and you can see here it's for these 4 ETFs, which comprise of a ton of companies in them, mostly tech companies.
Well guys, congratulations. You just made your first investment purchase and you're on your way to building your wealth empire. Now, you're not going to get rich overnight, so don't think that way, but don't be discouraged. It's going to take time to build this thing up, especially if you only have a couple $100s a month to invest. It's going to take a long time, but just know that this money is going to grow over time as well. So it's not just the $300 or whatever you're putting in per month. That number is going to consistently go up over time. Some years you may gain 5%, some years you may gain 20%. It just really depends on what's happening in the stock market and in the world and how much these companies make a difference in our lives. Just remember, we all started somewhere. Even myself, this is my first non-retirement account that I'm going to be investing in consistently every month for the long term. And then one day you're going to be old like me, or maybe a little bit older, and you're going to be telling yourself, I wish I would have invested earlier. Because once you catch that investment bug, you're going to start getting a little bit more greedy, and you're going to be wishing that you put more money in earlier so that way it would have grown that entire time. Trust me, it happens to everybody. Now, if you have a bit more money to invest, I wouldn't put it all in at once like I mentioned earlier. Maybe do a weekly buy until you get up to the amount that you want in there. So let's say you had $10,000 that you wanted to invest and you didn't want to wait 10 months to invest every month, right? You could do a weekly buy of $1,000 a week. That way you get there in 2.5 months. Or maybe you do weekly $2,500 until you get to the 10,000. That way you don't put all of your money in at once and potentially lose it all if tomorrow the stock market suddenly tanked like it did back in March. At least this way you can kind of average it out over a couple weeks, and that way you don't lose too much money if that does happen. Remember, time in the market is more important than trying to time the market. You're never going to be able to time the market. And if you can, you probably shouldn't be watching this video. Well guys, hopefully you found this video helpful. Investing doesn't need to be hard. As you saw, we just did a quick research, and if you're curious on how to do the research, just Google an ETF sector that you're interested in. And believe me, you'll find a whole plethora of them. Just check the expense ratio, check some of the holdings so you know what companies are in there. You don't necessarily need to look at all the balance sheets for every company because that's a little bit more complicated. If you just believe that that sector is going to make it in the future and grow exponentially, that's one you want to invest in. And remember, just have a plan and keep investing consistently. If you put in $300 a month, that's $3,600 a year. And if it grows 10%, you'll all of a sudden have $4,000. And if you put another $3,600 next year, you'll have $7,600. And if that grows 10%, well, it becomes $8,000. And so you can see over time that money is compounding. And that's how you build wealth. It's going to take a little bit of time. And once you get a little bit more addicted, you're going to want more money. And to be honest, guys, the best way to do that is to throw away your car payment and put your car payment towards your investment. That will grow your investment portfolio significantly. Well guys, if you liked the video, don't forget to hit the like button down below. It really helps this channel out a lot. If you guys like content like this, don't forget to subscribe to the channel. If you guys have other ETFs or stocks even that you think I should consider, let me know down in the comments below. I don't necessarily have to buy these 4 ETFs every month, but most likely I will unless I find another ETF that meets my goals. As always guys, good luck investing and have a nice day.